Are you a real estate investor and you're having a hard time qualifying for the property that you want to buy because your tax returns or your pay stubs and W-2s don't quite give you enough income to qualify for that purchase? Well, a DSCR loan might be what you want to consider. A DSCR loan is a loan that uses a calculation called a debt service coverage ratio. Debt service coverage ratio is a calculation that is a ratio of the monthly income, so your rental income, versus the monthly payment on that property. So the monthly payment would be the mortgage and the property taxes, the homeowner's insurance, and if there's homeowners association dues, those would be included too. So a typical ratio would be 1 or 1.25%. So for example, a 1 would be if your rental income and your mortgage payment were the same. And by mortgage payment, I mean mortgage plus taxes and insurance. So full monthly payment. So for example, if your rental income was $3,000, a 1 ratio would be that your full payment on the loan and the taxes and insurance would be the same. So $3,000 rent, $3,000 monthly payment. So that's 1. There are actually DSCR loans that don't actually have a ratio. You'll pay a higher interest rate for these, but they are out there. How we figure out what the rental income is 2 ways. Either use lease agreements, or if there's no lease agreements, we would be using what the appraiser uses as rent comparables. So they will tell us what the property would likely rent for. So if we get an appraisal and you also have leases, we're going to use the lesser of. So keep that in mind. Also, you can do a DSCR loan in an LLC. So this is different than a typical residential mortgage. Another thing to keep in mind is you'll need reserves. Typical is 3 to 6 months, but it's going to depend on your loan amount. So if this is something that might be something that you are considering, reach out to me. We'll see if this is going to help you qualify for purchasing an investment property, and I can answer any questions you have.